All right. Good morning. This is a good example of good things happen when you arrive early. So we're a little early. I'm Eric Hippeau. I'm a managing partner at Lerer Hippeau Ventures, and our panel today is consumer investing trends with a bit of an emphasis on New York, but not necessarily. With me today, starting over there, Adam Valkin, Managing Director at General Catalyst Partners, Brian O'Malley, partner at Accel Partners, Eric Feng, partner at Kleiner, Perkins, Caufield, and Byers, it all says it here, and then Josh Elman, who is a partner at Greylock Partners. Every one of our panelists have made some really great consumer investments in the past. Feel free to refer to them if you want to. But let's start with a very, very quick rapid fire question just to get warmed up. And starting with you, Adam, what is New York's biggest strength as well as its biggest weakness for technology, in technology?
I think the biggest strength is that smart, creative, talented people generally want to live here. And New York has and always will be a major hub for the most talented people in the world. I think the biggest weakness is that we still don't have enough engineers in the tech companies. We've done some analysis at GC, and in the top sort of 20 venture-backed companies across enterprise and consumer in New York, there are about half the number of engineers that just work at Google in New York. And I still think that that remains a challenge for the companies that we back.
Right?
Yeah, sure. Hey, everyone. So from my standpoint, I think the biggest strength is that New York is much more cross-industry as a market, and so San Francisco is largely just tech. And as technology permeates more and more industries, I think there's a lot of inherent domain knowledge here that can be leveraged. In terms of weakness, one of the things I see from this community a little too often is fundraising being celebrated for just merely raising funds as opposed to fundraising be a means to an end to building companies. And I see a lot of the best entrepreneurs are not the ones that are kind of out and about. They're the ones that are behind the scenes building their companies. And so focusing on building great companies as opposed to raising dollars.
Great question. I think the greatest strength is New York's access to culture. Consumer companies are now far more than just tech companies. It's a blend of tech accessing customer behavior and cultural trends. And I think the fact that New York is one of the cultural capital of the world is a huge advantage for providing consumer insights to entrepreneurs. And on the weakness side, it's not really something specific to New York, but I think every market outside of Silicon Valley has this one challenge, which is that in Silicon Valley, entrepreneurship is just really celebrated. In fact, going to work at a big company, you're kind of looked at as a weirdo. Like, why are you at Google? Why are you at Facebook? It's kind of strange. Like, why aren't you out doing a startup? And that just instills this virtuous cycle of entrepreneurship. And I think in most other cities, you're still kind of a little bit of the black sheep, quitting your cushy job at the investment bank to go off and start a company. So that's not just New York. I think that's most cities outside of the Valley.
I'll echo what Eric said about culture, and I think the ability, the thinking in New York, people to build brands, to build media, to do content businesses is just much higher and has a much more appreciation for what it takes to build those kind of businesses than even sometimes we do in Silicon Valley. And I think the ability to hire sort of non-engineers, great marketers, great brand builders, great content producers, if that's a big part of your business, is actually much easier here. You can get much more talented people than you necessarily can even building a startup out in Silicon Valley. I think the downside is that engineering, and I think for like the first 30 to 50 people in the company, including a whole bunch of engineers, New York is just as good a place as anywhere else. The real question is, when you start growing your company from 50 to 100 to 200 to 500 to 1,000 people, there's just so many people in Silicon Valley who've been part of that journey who can help you scale on the engineering side, on the product side, on the design side, and it's harder to find those people who can really help you scale and get that next level scale. Just because it hasn't happened for as many companies in New York yet. And so that's the thing where either you import that kind of knowledge and learning or you figure it out for the first time.
Do any of you think that Amazon will relocate or locate their second headquarters here in New York? Has there been talk about Brooklyn? Is that any chance that might happen?
Yeah, wouldn't it be cool if they did? I think Amazon is either going to go to one of these, sort of Midwest cities that like very high on the quality of life, very low price of property, and the ability for kind of a whole bunch of people to move and sort of relocate there, or they're going to pick somewhere like New York that's a cultural center that will attract a whole new wave, in the same way. I was just in Seattle at the end of last week. I grew up in the Northwest, and it's amazing how much Amazon has transformed that city, and it used to be a company town for Boeing, 30, 40 years ago, and now it's a company town for Amazon, it feels like, and it'll be interesting to see if Amazon can replicate that. It'd be great to see that in Brooklyn.
Okay. All right. Let me ask one more New York-centric question, which is that how much of your current fund, roughly speaking, is invested in New York, and do you think that's going to change when you raise your next fund? Adam?
Yeah, so we currently investing out of an $850 million fund, and we would expect about between 25% and a third of that fund to be allocated to New York. Typically, it does vary fund to fund, but we've built a pretty large New York portfolio. Our firm was originally a Boston firm. We expanded first to the Valley and then to New York. But in New York, we have companies like Lemonade, Oscar, ClassPass, Vroom, Bowery, and we've actually are about as committed to New York City as I think anyone.
Ron?
Yeah, sure. So New York has been and will continue to be a really important market for us. I'd say maybe 15, 20% of our funds. We've did the math before we came out here. We've invested about $600 million here in New York City across 50 plus companies. So things like Squarespace, Vox, Spotify, Envision, a bunch of different industries, things like Jet. And so we're going to continue to do that because it's been a great market for us.
Eric?
Actually, we just started investing our 17th venture fund, so the numbers are a little bit skewed because it's early on, but right now half of our investments are out of New York. We just did a whole bunch at the beginning of the year, a lot of them early stage seed bets, but that ratio I don't think will hold at half, but right now it's at half. Probably at steady state it's going to be closer to 10 to 20%, but just like with Brian and Adam, this is an incredibly important market, and I think some of the best consumer companies in particular are going to be coming out of New York over the next couple of years.
We don't look at it as a percentage basis at all, but we are looking for great companies wherever they are, not just in the Bay Area. We have a couple companies in New York active in our portfolio right now, and my partner is leading a seed deal out of New York kind of as we speak. So we're always looking.
Yeah, and I should mention that in our case, at Lerer Hippeau Ventures, we do about 70% of our companies, but that's a deliberate strategy, including the fact that when I received my 2 million mile card from American Airlines, I decided that traveling for work might not be as profitable. Okay, let's switch now to the consumer market. Consumer market is obviously very big. It encompasses a lot of companies. We saw some of them being demoed or talked about this morning. Adam, what is the most exciting thing in consumer today? What sector, what specific area are you looking at that's really exciting you?
Yeah, it's a great question. I discussed this question with my partner Spencer, who's standing in the back earlier today, and I think it really depends on appetite for risk and timing, because I think there are a lot of very exciting opportunities on the frontier. Things like AR and VR, where we've spent some time in the software biospace around longevity and pathology. But it's always tempting, especially for those of us that have worked in consumer over the last 10 years, to kind of keep an eye on the sort of high velocity marketplace and commerce opportunities that have happened. Although we do need to acknowledge that we're kind of late in the cycle, and growing has become much more expensive, especially with the market power of companies like Google and Facebook. So, the cost of building a large-scale consumer company today is just so high. And if you look at the size of the fundraisings of consumer companies in the more sort of traditional consumer sectors that we focused in, you have to believe that the companies you invest in are going to be good fundraisers and be able to attract a lot of capital. And just in my own portfolio with companies like Deliveroo and Vroom and ClassPass that have done well, it's just these companies require a lot of capital. One area that continues to be very interesting to us is just broadly the future of work and companies that are helping to drive the employment process, both sort of 1099 and W-2. I think there are lots of interesting companies emerging around the blue-collar space, and I think that continues to be an area of interest. Some of our most recent investments in New York have really been in the farming space, indoor farming like Bowery, and in the insurance sector with companies like Lemonade.
Brian?
Yeah, sure. So I tend to think about consumer investing as really ultimately being about people. And while we might be late in the cycle for your kind of 28-year-old San Francisco-based single engineer guy, there's a lot of people out there where technology is just starting to really solve their problems and really impact their families. So we're spending a lot of time around financial services, healthcare, solutions for families, solutions for different age demographics. And so in that area, the mobile phone is still very much king, and the power of a very powerful computer in your pocket to someone in San Francisco feels kind of old news, and people have moved on to new things, but we still think that there are a lot of great markets that are still in the very early days of being touched by technology.
So Eric, you were the CTO at Flipboard, correct? Yeah, which obviously one of the great consumer applications, interesting enough, out of San Francisco and not New York.
Very kind.
What are you focused on these days on the consumer market?
Yeah, funny enough, so I spent the last 10 years in an operating role at ad-based companies, so Hulu and Flipboard, monetized all via ads. I could not be more bearish on ad companies. And largely because I see Facebook and Google as these massive duopolies that are sucking up all the value of ad-based businesses. So I think it's going to be a real struggle for any company to monetize and build a sustainable business on ads. So for the last couple of years at Kleiner, I've been focused almost entirely on transactional business models, anything from marketplaces, subscription businesses to pure play e-commerce. And in fact, I think e-commerce is a really exciting, interesting area. We talked about Amazon, the giant Borg that's sucking up all of e-com. But when you think about the size of the market, how big it actually is, Amazon is still a very small player in all of commerce. And what makes commerce really exciting for us this time around is with every generation, you have brand turnover. So, my parents might have shopped at Sears and I shopped at Dillard's. And, this is a very natural thing that happens. But with this next millennial generation and then Gen Z, the next generation after that will have buying power, we predict that the brand turnover will be probably 10 times what it was in previous generations because of technology, because of digital distribution, because of mobile shopping, because of just very different experiences. The difference between Sears and Dillard's was actually quite small, but the difference between Dillard's and Stitch Fix is massive. So we're predicting a lot of brand turnover, which creates a lot of interesting opportunities for companies to rise up and take their place at the big boys table.
Perfect. Josh, your most exciting area of consumer trend,
Look, it's easy to say consumer's dead. That's what a lot of people are saying right now. But we have a whole day on consumer, which shows that it's not. To me, the biggest shift is like these phones in our pockets, and I see like several of you still on your phones right now. Like these are only 10 years old. Like we still don't understand the power that these are going to have in their lives, the amount of money we're going to spend. If you go to China, over 50% of commerce is done on mobile, through WeChat, through WePay, other things. There's a product there called Toutiao that has 150 million daily visitors to their new site. It's kind of the Flipboard of China, but now it's a big giant. And they're actually setting some trends. I look to China a lot they're setting some trends that I think we might even be following because they're a little bit more of a mobile society. They skipped the desktop web, so a lot of their products were still native on mobile. I think we're going to have a mobile 2.0 renaissance. We're going to see a lot of products built that that do important things for us, that we spend money on, whether we're spending money on mobile native media products that are vertical, that operate in a different way, whether we're spending money on commerce, whether we're discovering our favorite brands and being able to spend money on the brands. And I think we're going to see a whole nother wave of innovation that's happening here, right when everybody sort of says it's dead. Sort of like what happened with Web 2.0, call it like 14, 15 years ago, when everybody was like, oh, the web's dead, Yahoo, eBay, Amazon, Google have won the internet, and all of a sudden there was a whole bunch of new innovation, little companies like LinkedIn and Facebook and MySpace and everything else that came out. I think we're kind of ready to start seeing that on mobile, and I think it'll happen in the next few years, but it takes people to kind of be creative and sort of start to reject the core that just, Google and Facebook and Snapchat have won.
Yeah, I actually think one thing on that, I think it actually takes one more thing, which is some of the funding to dry up, right? Where you actually need more of a fertile ground for these companies to grow. And one of the things that you're starting to see is the funding starts to dry up for mobile a little bit. It helps these companies grow on their own a little bit more, which is the right sort of environment you want for the next generation of companies.
And on that, it's really important that things don't just have to grow organically and free. We kind of got addicted to that over the past 10 years. Everything's growing so it can find free distribution through search or through Facebook or whatever. It's okay to actually pay for marketing to your users if they spend money on your product, so it's ROI positive marketing, and you actually create real long-term retention and can build new brands and build new engagement. And so we're seeing a lot of that too. And we look now not just for product market fit, but what we call product channel fit, which is your marketing channels actually supporting your product in a way that's unique and defensible and will be recurring itself versus a channel that might dry up.
Well, so let's pick up on a bit of a theme here, and Josh, I'll start with you because you happen to have worked both at Twitter and Facebook. So the big tech companies, the ones that we all know about, are they stifling the environment? Are they killing innovation to a large degree? Are people scared to build something because Amazon might do it or Facebook might do it? What's your perspective? And I'll ask everybody the same question.
I'll hold Amazon aside for a second. If you think of the big companies, they each do one thing incredibly well. Google helps you find information across the internet, or YouTube helps you, find and watch great videos and host your videos. Facebook helps you connect with your friends wherever they are and stay in touch with your friends. Twitter helps you get connected to the world's information. And so if you're building another product that's trying to connect friends, it is a little hard to build a whole new defensible way to try and connect friends, because likely Facebook will realize that's important for their users. And if you've tapped some need that some groups of people have, Facebook will be like, whoa, why aren't we bringing that out to everybody? So if you're just trying to go after these same needs that these companies serve, you could call it stifling. I just think it's going to be hard to kind of build something that's big enough, because those needs are served fairly well by the products that we have, and one little extension for them lets them bring some new feature to their users in a way that doesn't touch everybody else. Snapchat might be the last one that sort of carved out at least a big wedge in terms of connecting friends. On the other hand, there's still so many things we do in our lives that are not digital or that we're not serving, and I'm encouraging founders to go for those and find those. Whether it's places to be entertained, you might not be satisfied with the current set of entertainment. Gaming is a massive industry that I think is very untapped. We're investors in Discord, which is a way that people connect around playing MMO games on their PCs, and it's grown from 200,000 users when we invested less than 2 years ago to 12 million or 10 million or something today, every day on the product. And so I think there's so many different ways that we can do things that are outside of what Facebook does or what Twitter does. But if you're like, hey, Twitter could be, Twitter maybe is a bad example. Facebook could be a little bit better if you could just do this. Facebook will probably get to that.
But Eric, to your point, though, I think the numbers are that 90% of incremental advertising dollars go to Facebook and Google. So you're not too bullish on supporting an ad-based company. Are there any other areas that you feel reluctant to invest because of the big tech companies?
I don't know if this is controversial or not, but I think that the big 5, 6 tech companies in the world are absolute monopolies, in every definition of the word except the legal definition, which is the challenge. They don't do consumer harm. They're pretty good about understanding where the line is with Sherman antitrust, but I think they are monopolistic companies that do stifle innovation, but the challenge is that there's probably no end to that in sight. Again, they are very savvy about not doing consumer harm. In fact, they largely exist for the consumer's benefits. They're incredibly sophisticated, they're hungry, they're ambitious, they are here to stay. There's no black swan event that I see that would ever disrupt the large 5-6 tech companies in the world. They will only get stronger. And if that's the reality that we live in, the challenge will be to find the opportunities that you kind of step in between the feet of these giants. And that is the reality. I don't fight that nor dispute the reality. I just sort of accept it. And some of the areas that we look for is, I think in every single one of the large companies, they have a little bit of a blind spot, not a huge blind spot, but maybe one that's just not their focus area. For example, Google just doesn't really care about e-com. They just don't care about transactions. They're so wedded in advertising revenue. You could argue Facebook's the same way. Amazon, they just really don't care about social and connectivity and discoverability. It's all about intent-based utility of shopping. So maybe that's a hole there. Apple, to this day, I still don't think gets the cloud. I think that their cloud offering is just awful. So maybe there's a little bit of hole there. So I think with all of them, there are areas that are a little bit murky that maybe you could step in, but it is hard. I think the reality that we all live in right now is, right now for consumer companies, it's just very challenging because of the existence of these monopolies.
So I think you were an investor in Hotel Tonight, which was an OTA that showed up after everybody else there and carved, because they were mobile first and very convenient, carved a substantial space, not only confronted by Expedia and the other OTAs, but also by the big tech companies. So obviously this is all possible.
Yeah, like if you're gonna try to do something in travel, that's probably the most competitive market out there. It's an area where the incumbents are certainly not asleep at the switch. They've got huge advertising budget. Booking.com is the largest advertiser on Google. And so they really focused on initially a niche. And a lot of times, I think we forget that these companies that have now become large platform businesses started out almost as toys, right? And they were dismissed by the large players because they were not seen as serious threats. So obviously, Amazon started out with books. Facebook was a way to figure out who was in your classes. And so today what you have is you have a lot of companies that try to skip to the platform step almost day one, where they come and kind of punch the giants like right in the face. And a lot of times, I think you're best to own a demographic or own a particular use case. And so in Hotel Tonight's example, it was really last minute day of booking where being on mobile and being very convenient was important. But they've now gotten to the point where a lot of their customers really love that booking experience. They want to do it more than just last minute. Because they like the curation, they like the way that Hotel Tonight works with their properties, they like the convenience. And so we recently expanded the booking windows to 100 days, which a lot of people look at and say, hey, now you're just like Expedia, you're just like these big guys. But that's ultimately what you need to do, is right? You need to eventually go after the big market opportunity, but you don't necessarily want to start there day one. You want to start something that really grabs affinity from your consumers. Hopefully they end up loving the product and want to have a broader relationship with you as a company.
Adam?
Yeah, so I think there are two lenses that you can kind of view the big five, Apple, Amazon, Facebook, et cetera, through. And if you look back, the picture is much prettier than if you look forward, because monopolies generally behave very differently on their way to becoming monopolies than they do once they're there, and they can extract their toll. And from someone who was involved in venture capital outside the U.S. for 14 years before coming back here about 4 years ago, the real positive impact of Amazon, Facebook, Google, et cetera, was that they really democratized access to internet entrepreneuring to people anywhere. So companies like Supercell and Spotify and others that came out of Europe, or gaming companies that came out of Belarus and Serbia and elsewhere, just couldn't have existed if there wasn't, AWS and iOS and Android distribution and, et cetera. So there was a hugely positive role that has been played on entrepreneurship globally, and many of us have been beneficiaries of that. But the real question going forward is, what kind of toll do they extract? Because if you're a venture-backed company paying, Amazon for AWS and distribution, Apple for their 30% cut on iOS and whatever else, and Facebook for distribution and registration, what's left? What is the economics that are left at the end of that? And that is getting scary, I think, right now for venture-backed companies.
I think it's important to separate that a lot of these large companies are actually really good for entrepreneurs and for people who are looking to build companies because they make it a lot easier to do that. They're not necessarily great for venture scale companies because those are the areas that they care about as well.
Now, big tech monopolies have a way to just go away. IBM, Yahoo, which I know very well, so I agree. They look like formidable at the moment. But for instance, the data shows very clearly that younger people, the Gen Z generation, is not really active on Facebook. Now they're active on Instagram, which is a Facebook property. But what happens if people start, using Facebook on a regular basis, don't even show up with a profile or anything like that? It'll take a long time, but it might still erode over time.
No, I was just gonna I'm like losing my voice. I was just gonna say, I think one of the big differences is that the older tech companies would acquire businesses and then try to roll them into the fold and almost like make them become part of Microsoft or IBM or Yahoo. This generation is much more sophisticated about letting these entrepreneurs continue to run their business, but do it under the fold of Facebook, right? So instead of Instagram becoming a feature of Facebook, Instagram was able to evolve it as its own platform. And that's a much scarier thing as we think about the incumbents, as opposed to if they were to acquire a company like WhatsApp or Instagram and just get rid of it along the way.
Yeah, the difference is that they're smart enough to keep them separate, right? So let's talk a little bit about the other end of the spectrum, which is what happens with M&A and IPOs. So there's been some really good M&A activity. Plated, which was one of our companies with Albertsons, Bonobos with Walmart, etc. But there's like really large consumer tech companies out there that have been around for a number of years. Warby Parker might be a good example of that. And they haven't gone public. They haven't raised money for a while, indicating perhaps that they're cash flow positive. They don't need to raise any more money. What's the Adam? What's the perspective in terms of exits and IPOs and M&A in particular for consumer companies?
Yeah. So I think it's interesting time that there are IPO exits going on, as we know, but those are generally few and far between in our industry. Especially if you look at New York, there's not a sort of large number of companies that have gone that path. In the venture business, generally we are hoping that our companies will be acquired in a competitive process by large companies that have a lot of cash, and they will pay an outsized strategic price for the companies, and that generally has involved the tech companies, the Googles, the IBMs, Oracles, Facebook, and others. But I think we're definitely entering a phase where just because of the major disruption that's going on in the big vertical industries, financial services, healthcare, travel, etc., where there will be consumer goods and retail, as we've seen recently, there will be a lot of acquisitions, some of them defensive, from very large companies with huge cash flows that can pay up for the best companies. And we saw that with Dollar Shave Club and Plated and others. But I think there'll be a lot more, especially with the threat of Amazon. There'll be a lot more of that. I also believe that in financial services and insurance, where there's just a lot of disruption happening from fast-moving tech companies, that some of those companies will be major buyers. And we've made a lot of bets in the insurance space. There are, I believe, 50-ish insurance companies in the Fortune 500. There's some big companies, and they've been around a long time. The average age, I believe, of those companies is about 100 years. And these companies are going to need to make investments and acquisitions. So I think it'll be an interesting time ahead. The question is always, will these exits be big enough? And who's going to buy companies for $1 billion or more?
Brian?
Yeah, sure. So we as a firm have gotten pretty good over the years at helping our companies, if they want to go down the path of M&A, sell to the large tech companies. This new wave of buyers, which is really cross-industry, as Adam says, is a group of companies that we don't know as well, right? So we don't have great relationships with folks in like the pet space or and so this is something that we're trying to understand because it's clear that this wave of large acquisitions is driven much more by fear from large incumbent companies that are willing to spend a lot of money to make sure that they stay relevant in this new world. But that's a much wider swath of businesses. And so I think the good news for entrepreneurs is that the list of potential acquirers that are willing to spend a lot of money for companies has grown dramatically. The hard part, though, is that those companies don't have as much of a history of buying businesses, and so the processes might take longer, or there might be a lot more tire kicking, and so there's going to need to be more assistance along the way.
So one more thing to add, sorry, just before Eric jumps in, is just it's important to mention the private equity buyers, people like Vista and Thoma Bravo, and SoftBank, and all types of new buyers from China and elsewhere, because this is having a very clear impact on our business, mostly positive, but kind of early to fully understand the implications. But definitely a lot of buyers that exist today that just never existed 5 years ago.
For what it's worth, we keep talking about the big companies being fearful and needing to buy out of fear. And I've actually seen the ones that have been the most aggressive have actually been very smart and leaning forward to really say, hey, we need digital expertise that's going to move this company forward. Unilever buying Dollar Shave Club was not a fear-based acquisition that they were going to get wiped out. As they said, somebody's built a digital subscription business with direct-to-consumer marketing in a way that our company does not have the expertise to do that. Let's go out and get that team and actually give them a lot more responsibility. You see the same thing with Walmart and Jet. Congrats to Brian and the Accel team. And you're seeing that in a whole bunch of places. So there are some fearful companies that are like, we're so desperate, maybe this digital team will save us. But I actually think a lot of what we're seeing is look, recognizing that technology is moving the world forward, and those companies that have had a way of doing business for decades or more, are saying, hey, we need to get digital expertise. So if you actually start one, figure out how to get unique consumer demand, you figure out how to actually understand something about the business model that technology enables, both on marketing, acquisition, and retention of your customers, that can be very valuable to these larger businesses. You think you're trying to disrupt them, but in fact, there's a lot of things that they add value to, and actually putting those together can be even better.
Yeah, I think that if you look at the history of a lot of enterprises, think about it. 100 years ago, the concept of management didn't exist, right? Peter Drucker invented management. So there were companies that were like, we are a management-based company. And there were companies that were like, we don't do management. And that was a differentiator. And then 30 years ago, there were companies that didn't understand international at all. Like, we are an international company. We actually have people that consume our products outside of this country. And then there were companies that were saying, no, we're not an international company. And there was like an actual line of differentiation. And, as recently as 10 years ago, there were companies like, we're a tech company and we're not a tech company. But I think as this evolution has come around, in the next 10, 20 years, every company will be a tech company. Albertsons is a tech company. It will be. Technology will be a core part of what they do. And I think what that does is create a lot of interesting opportunities for entrepreneurs that are really native and immersed in this field to be a part of larger organizations, to be a part of larger businesses and help transform them. For example, we often forget just how healthy some of these companies are that are not quote-unquote tech companies today, but will be tech companies in the future. I'll give you an example of a category that I spend a lot of time in, which is the dollar store category. So I have an investment in a company called Holler, which is an online dollar store. The largest player in this space is a company called Dollar General that does about $25 billion in revenue, annual revenue. It's a meaningful business, and it's just not one that we think about. But there's a lot of businesses that are like that do tens and 20s, if not hundreds of billions in real revenue. And these companies will all be tech companies, or they're already on their way to becoming tech companies. And I think that does create interesting partnership, acquisition, roll-up opportunities for entrepreneurs out there.
By the way, Albertsons is doing exactly what you just described, which both of you just described, which is they like the business, they see how they can expand it, they have brands that they can attach their name to it, but also they're buying the DNA. It's not an acqui-hire by any means, but they're buying the DNA because they think that thinking like a tech company is gonna, they have 3,200 stores around the United States. They can do a lot that they don't do. And the acquisition of Whole Foods by Amazon shook everybody up in the grocery business because in grocery, there's a tremendous amount of data. They know exactly what's moving off the shelf and at what margins. They just don't know what you're buying. And that's what Amazon knows, and that's what shook them up. So I think we will see a lot more of that. So it used to be a few years ago, and I think that might have stopped, that VCs would say to their companies, no worries, we're here forever. There's money, the unlimited supply of money, and you never have to think about going public or an exit. I think that sentiment has changed a little bit. So what advice do you give your companies, particularly the ones that have been in your portfolio for a few years? How should they be thinking about an exit?
So 2 years ago at every board meeting, we were saying, raise capital now, even if you don't need it. Not because you might need it in the future, but not because it might go away, because we didn't know when it was going to go away, but we said it's never going to get better than it is right now. And that was 2015, and starting in kind of the fall of 2015, it started to go away, like it wasn't as easy to raise capital. And so what we tell our company now is, look, assume, you can forecast 5 or 10, 3 to 5 years out now, not 5 or 10, that's probably too hard, but 3 to 5 years out, like you are either going to keep growing, and the couple of really good companies that keep growing, their businesses get better, they will be able to raise more capital. There's still, with interest rates so low, there's still plenty of capital out there that's seeking alpha. But we say, look, not everybody's going to be able to raise, and so you need to be able to tell a better story. What are your unit economics going to be? What are your user economics? How are you acquiring users? How much are they paying you? How much are you going to be able to make? If advertising is very hard to do, like Eric said, which I agree with, you're going to need to figure out how to be able to make money on a per user basis. So we encourage everyone to kind of draw lines towards what that eventual good business looks like. And if growth still happens ahead of where those lines intersect, there are people who will fund you and give you more money. Maybe SoftBank is the current patron saint of any growth company. But we do encourage people to do that as opposed to just grow forever and someday you'll have to figure out what the business is.
I completely agree with Josh. I think in this market, people just need to be more pragmatic. We tell entrepreneurs that we don't know what will kill your business, but we do know that running out of money will 100% kill your business. That has like a 100% fatality rate if you run out of money. So that's the one eventuality that we try above all else to avoid. The way that we approach it is that actually we always look at cash out date. It's like the first stat that we look at in every board meeting. And when you're within 12 months of cash out date, you're raising money. You may not be, doing 4 pitch meetings a day, but you're starting the process of raising money when you're within 12 months of cash out date. So that's kind of the line of demarcation. And the good news is that I think it was Adam that mentioned this earlier, but there are a lot more sources these days, whether it's capital overseas, whether it's, large hedge funds that are starting to move downstream, whether it's ICOs, whether it's, just a lot more angels and friends and party rounds, whether it's banks doing more aggressive convertible notes. There are more sources of financing, so that's a good thing. But the age-old adage of you can never raise too much money. I think that still is true, and we encourage our entrepreneurs just to be very fiscally conscious about that.
But Brian, at some point, they're taking VC money, risk capital. The pact is that they have to sell the business at some point, right?
Look, at the end of the day, we have 2 customers as investors. We have the entrepreneurs we work with, and we have limited partners that are nice enough to give us their money to invest on their behalf. So it's our job to manage those 2 parties and to make sure the incentives are aligned. I look at IPOs less as an exit or liquidity. Obviously, that is an important factor of our business.
But the best companies you're not selling in the IPO, right? You rarely can sell in the IPO if you're one of the largest outside shareholders. It's really about building a sustainable public company. And I look at a lot of businesses that have gotten a whole lot stronger once they became public. They had a new currency, they had greater recognition from their customers, and their business transformed to the positive as a public company. They didn't look at that as a exit event, they just looked at that as a step in maturation. The big challenge that we've had is that a lot of these companies have grown very quickly, and they don't have the maturity from the finance and back office perspective to have the predictability to be a public company. Like, it's a lot harder to be a good public company today than it was 10, 15 years ago, and you don't want to be a bad public company because that's a tough place to come back from. And so we see if a company has the ability to be a sustainable public company, it's going to be a positive effect. We want them to be far down on that path to going public, and that's not always an easy conversation, but we think it's in the company's best interest. But it takes a while to get ready, and it's a multi-year process. So a lot of our companies are in that process. We just want to make sure they do it correctly so that when they're a public company, they don't miss a quarter out of the gate, because it's really hard to come back from that.
So I would just say on the fundraising thing is, I don't know if it will be easier or harder to raise money in the future, but what I do know with certainty is that there's never been a better time to raise money than today. There's just so much money out there at every single stage, from seed all the way through to sort of growth stage pre-IPO money. I think that the best founders, the best companies raise way more money than they need, but spend way less money than they can, because that's the way you address the sort of primary concern that people have, that if you have too much money, you'll spend it. And I think a lot of companies hurt themselves by overspending, but I don't think they hurt themselves by over-raising, because who knows what tomorrow holds, as we've learned many times before.
Terrific. So I think we have some time for questions, do we? Yeah? Is there a mic that we can share? Here's a mic. Does anybody have a question? We have to have at least one question, just to demonstrate that you're participating.
I'll ask. I actually have a couple, but one of them, this was even the case for us. I think it was Brian that spoke to this, the challenge between moving too far ahead and, let's say, companies feeling the need to build platforms right off the bat versus being more focused and vertical. And the importance of being vertical. But I think one of the challenges we have as entrepreneurs is when we go out and raise, we are challenged to build platforms from the outset. So how do you feel like that I think fundamentally conflicts with what we need to do versus what we have to sell in order to raise money? Would love to get your feedback on that.
Brian?
Yeah, I'll take that. Look, so speaking to you guys, I think you guys did a great job of being like, we're about pizza, right? And you talk to people and they'd be like, oh, well, what about all these other things? It's like, no, like pizza's huge, we're gonna do pizza. And I think having that clarity is a real positive as an entrepreneur and as investors. Like, sometimes you ask a question, not because you want them to say, oh yeah, we're gonna do every kind of food. You actually want the entrepreneur to say, no, like, we're gonna be very focused and very deliberate about what we do. And that's just as part of the process of finding the right fit, right? You want investors that can understand that to get to phase 3, you got to do phase 1 and phase 2 very well before you get there. And I've had, it's interesting, once we invest in companies, we get all the feedback as our founders go out and raise the next round. And a lot of times they'll have conversations where like, yeah, these new investors, they just don't get the path. But there's, 1 or 2 people, and they're like, look, there's a lot of clarity there, and that's the kind of partner that they want when they go out to the next funding round. And at the end of the day, like, you really just need one person to get it. It's great if you have a couple, because that, makes it a little easier from a process standpoint. But I think that I see way more companies that have a lack of clarity of focus that's really scary, and out of the gate, they're like, yeah, when we have 10 million users, we're going to do all these things. And it's like, well, why do the first 100 people use your product? And then from there, why do the first 1,000 people use your product? And so I'd much rather have that clarity. And then when you get there, you'll figure it out, as opposed to the other way around.
Any other question? Yes, over here. We'll wait for the mic.
Yeah, great panel. Thank you.
Sorry. We're good to you next. Yeah.
Okay.
You got the mic.
We've discussed the tech companies, the large tech companies, as threats to emerging companies, and I'd be curious to get your thoughts on the large tech companies as threats to consumer venture investors. Insofar as they host and or provide distribution in so many cases, and could there be, and maybe this is motivated by a desire to allay antitrust and job destruction concerns, or maybe it's just kind of business logic, but curious as to whether you could envision next chapter in which they provide maybe systematic, almost algorithmic support to consumer startups, and obviously look very different from the the Slice experience, I guess, with First Round, but maybe it's somewhere between kind of corporate VC and local regional banking. I don't know what it exactly looks like, but kind of big picture, how do you regard the large tech companies, vis-a-vis the job of consumer VC?
The large tech companies are altruistic beings.
Well, look, I think there's an interesting analog, which is a very different model in China with Baidu, Alibaba, Tencent, which is they're very, and Xiaomi, and they're very active investors in the startup economy. And in fact, if you're a startup, it's actually very hard to build a big company without getting one of them to invest pretty early on, because then you're kind of part of their keiretsu, and you're part of their family, and they'll give you some distribution, and they'll give you some help, and you know that they might not eventually compete with you because they own enough that they're happy if everybody wins and you're using their payment systems or other things. In the US, we've seen the big companies use their data and use their advantages much more for their own good. I mean, we know Facebook has a tool that they can kind of see what's happening with a whole bunch of mobile apps and use that to sort of identify where there might be opportunities for them to build more things. So I have yet to see the company sort of want to go and sort of invest in the ecosystem and see all these other things flourish. But maybe that'll change, and maybe there will be, government reasons for that to change. Maybe there'll be economic reasons where they'll realize, being much bigger. Apple, for whatever it's worth, doesn't invest in companies per se, but it makes 30%. Apple and Google Play have a 30% tax on basically all dollars that are spent through mobile, which is kind of incredible if you think about it. It's, a 30 billion or 40 billion is spent through these mobile, app platforms worldwide every year right now, and those guys are taking 30% off the top. So they're incentivized to see everybody win, but they're kind of incentivized, and they do a lot of work to help those companies win, even without sort of owning equity or investing capital.
I think we have one last question here.
You started the panel talking about how it's one of the hardest time to create a venture scalable company due to all the threats from the big tech companies and dependence upon them. And then you talked about how it's the best time to raise venture capital. There's a great amount of venture capital from everywhere. How do these two things coexist, and where does that go? Are VCs going to just lose all of that money?
We're not going to lose all of it. We'll lose most of it, but not all of it.
Only one.
That's right. No, I just real quick on that, I think part of the reason that it's harder to build these very large companies is because there's so much money out there chasing these businesses. So if you take a space like personal finance management, right? So there maybe historically would be like 3 new companies or 4 new companies in that category that would raise money. There's literally, dozens, and a lot of times they're competing with each other for the same demographics, the same AdWords, and they're all using venture dollars to get there. So at the end of the day, there's a very similar amount of companies that reach large scale. There's just a lot more businesses going in the top of the funnel that have actually raised institutional capital, and they're duking it out with each other on the same ad channels. And so one of the things we look for is who's actually taking a different approach than a lot of the other companies that have raised money in the space, because that's going to pay off in the long run.
And maybe just to end on an optimistic note, I don't have nearly the wealth of experiences as Adam, Brian, Eric, and Josh, who've been doing this far longer and far better than I have. But I love chatting with far more experienced people, and they always remind me that in the narrow focus when you're looking at this exact moment in time, things may look bleak, but back in the late 90s, everyone thought software was done. Microsoft had won all of software. There was nothing left in software. And then 10 years after that, there was just nothing left in the internet because Yahoo and Google had won that. And when we're saying like, hey, there's nothing left, maybe it's actually a really good time to start companies.
Brad, did we say you have time for one more? Or, okay, over there? Yeah.
Yeah, I would love to hear from each of you about one company you wished you had invested in, and not Facebook, but something in the last couple of years. What's the one consumer company you think, I'd love to have that in my portfolio?
And by the way, I'll start, and for me, it's Dollar Shave Club, because one of the founders came out of one of our portfolio companies, and we thought that the valuation was too high.
I'll go next. One of the ones that I love is Stitch Fix. I think we first met Katrina Lake, the founder, in 2012, and she presented, I'm going to build a great team of data scientists. I just hired an incredible data scientist, and we're going to figure out how to personalize shopping with the human touch. And we're seeing all this traction because we're able to buy cheap Facebook ads in certain parts of America where they don't have access to some of the brands in the stores. And the reason that we ended up not leaning into invest back then was it looked like a very hard business to build. You had to deal with sourcing all this inventory, shipping it out, getting it back, processing the returns. And we're like, how is that ever going to get real margins and everything else? We did believe that there might be some demand there and it was a good offering, but we didn't know that it would get this big. And we just missed on how easy they were going to be able to effectively get customer acquisition and how powerful this data science team was actually going to be to really be able to personalize things based on style and fit. I think I'm half dressed in Stitch Fix today for men, so it's a company that we certainly wish we'd been part of.
I think one of the most interesting social companies right now is Discord in Josh's portfolio. I wasn't around for that investment decision, but it is a phenomenal company and one I certainly wish that our firm was involved in. Me personally, a company that I really wish I was invested in is actually in the room today, which is Slice, over with the Lerer and those guys. Love the company. Love the fact that they just gave everyone in this room $10 a pizza, which is pretty awesome. Subsidized by Jeff Richards at GGV. Thank you very much, Jeff. But love the, for this one, it just came down to the entrepreneur and the team. I mean, when in doubt, bet on just great founders, and clearly Lerer and Peter and the team are amazing.
Yeah, I was actually going to say Discord as well. So another one for me, a company called Rover, a Seattle-based business in the pet space. I do not have pets. I've never had pets, but the thing that got me interested in that business was that they really understood something that was top 3 priority to consumers. Right? If you're a pet owner, if you're a dog owner, understanding how you care for your dog is number 1 on the priority list. And those guys have done a really amazing job from an execution standpoint. And they just keep opening the window for other areas that they can go into. So I think that fits the example of something that at first blush looked like kind of niche-y to me. And if you look at how those guys have executed, they've done a really good job expanding their pie, and I think that they've got a bright future.
Yeah, so for me, just a couple. In New York, I really wish we had done Casper. One company that I really am intrigued by on the West Coast is Patreon. Kind of combines all the things that I think are cool about the future of work and entertainment. In Europe, I have a lot of respect and admiration for a company called TransferWise that has just built a phenomenal product in that space.
So great. Let me just leave you with one piece of data, which is that between the East Coast and the West Coast, so it's more than New York and it's probably more than San Francisco, but obviously San Francisco and New York are the big centers. Between New York and between East Coast and West Coast, the returns on VC invested money is exactly the same. The multiples are exactly the same. There's various pieces of research that shows that. The big difference is that the money coming in on New York is smaller than money going in on the West Coast. In other words, the valuations are lower, and the demand for capital, therefore, perhaps because of the size of the ideas, maybe on the West Coast are bigger. But from a return on capital invested, it's exactly the same. So thank you very much, and enjoy the rest of the day.
And thank you, Eric, for a great job moderating.